Good morning and welcome to the Inspired PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it received in the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Mark Dickinson, CEO. Good morning to you, sir.
Good morning, everybody, and welcome to the Inspired PLC 2022 interim results. Presenting today, you've got myself, Mark Dickinson, CEO, and Paul Connor, CFO. I guess we're in a place now where a number of people have heard about the business, so we don't intend to do a lot today in relation to introducing the business and taking you back through a lot of the kind of background to the thesis, but rather, given all the topical things in the market in relation to the energy crisis and all of the other kind of macro factors, we're really going to focus on explaining the segmental results and ultimately the kind of outlook for those business units. So just to recap then, Inspired PLC, what do? We help corporate businesses deliver net zero and manage their response to climate change whilst controlling their costs. And in today's world, the controlling their cost part is really important. We do that through three divisions. Our energy division, which provides assurance services that helps customers manage the cost side of the price side of their energy cost equation, and also energy optimization services, which help them manage the consumption side of their energy cost equation. Our ESG services help companies make their ESG disclosures and deliver their journey to net zero. And both of those divisions are underpinned by our own proprietary software, which we also make available to third parties on a SaaS basis in the Inspired Software division. If we look at where we are today, we are a technology-enabled service provider. The insights and advice and support we give to our customers is all based on managing large amounts of data every month, making sure we process that and gain the appropriate insights for the clients. We work for corporate businesses only, so we're not in the SME market, and we've got around about 3,500 customers. If you look at our customer base overall, Inspired is not an energy supplier. We don't supply energy to anybody, but we actually help consumers that represent 6.7% of the UK market with respect to managing their energy and carbon costs. And there you can see our place in the competitive landscape as produced independently by Cornwall Insight. And ultimately, we are the player of scale in this marketplace, around about twice the size of our nearest competitor. If we think about the opportunities that we have, ultimately it's a £2.5 billion marketplace, and really that builds from providing assurance services to our customers with respect to energy, which really plays to a lot of non-discretionary recurring calls to action where everyone must have an energy supply contract. We help them get the right contract in place. And then ultimately we help them ensure that they've accounted for that energy properly on a month-to-month basis. So this gives us an opportunity to work with the clients, process all of their data, provide the financial insights they need, and ultimately build that relationship as a trusted advisor. Our ESG division ultimately does the same sort of thing for ESG disclosures and carbon accounting, going all the way through to Scope 3 emissions. And that becomes increasingly important in today's market, where ESG has become a fundamental driver for winning contracts and growing revenues. So ESG is not about meeting a compliance need. It's actually a prerequisite now for businesses to be able to actually get contracts and grow their revenue line. And we help them do that. From that standpoint of having those two underlying divisions, all paths lead to developing a carbon action program, to delivering net zero, and ultimately to reducing energy consumption, which is particularly pertinent and topical in today's marketplace. The great thing about that is we do that from a position of a trusted advisor, and we do that already having an understanding of the client's data and information, so that when we go to them with something that will help them save energy or save carbon, it's not a concept, it's not an intellectualization, it's something that's factually based on the real position of each individual customer. As we said before, that's finally all underpinned by that proprietary technology, which is built in such a way that it can operate providing software to third parties on a SaaS basis. So that's ultimately how the opportunity break builds up. And what we're going to do now is really start to focus on the H1 2022 performance. So Paul's going to walk us through the financial highlights, then I'll take us through some of the macro factors we're seeing, and then we'll focus on reviewing each division in turn.
Thank you, Mark. So H1 22 was a period in which we've delivered results in line with expectations against an unprecedented backdrop in UK energy markets. The period has seen the group deliver a 24% increase in revenues to 40.5 million. But importantly, in terms of what's driven that growth, it's very much been driven by that continued shift in revenue mix, with our optimization services division delivering a record 49% increase in revenue in the period. As indicated in the results announcement published yesterday morning, we expect to see this shift in revenue mix accelerate further in H2 and beyond, with the economics of investments into energy reduction for our customers transforming in the current existing market conditions. As a result of that change in mix and the greater contribution from our lower margin optimization services division, the 24% increase in revenue is translated as a 10% increase in EBITDA and an 8% increase in adjusted EBITDA. In terms of cash performance in the period, pleased to see a continuing improvement in underlying cash generation, particularly significant improvement when compared to H1 21. Despite the improvement in cash generation in the period, you'll note that net debt has increased over the 6 months from 32.9 at 31st December 21 through to 42.9 million at the half year. And that's been driven by the expected payment of 10.2 million of contingent consideration. As we look forward to the second half of the year, contingent consideration payments will be relatively modest, and therefore the peak net debt position at the 30th of June of 42.9 million is expected to reduce in the second half of the year for the year end. With that continuing trend and improvement in cash generation, we're pleased to announce an interim dividend which will be payable in December, which has increased in line with earnings in the period. And now we'll take you through the segmental reporting.
So I think, guys, to put segmental reporting into context, it's important that we think about the kind of current market environment. The bottom line of all this is that the energy crisis is very real. There's not just the domestic element to this where we've got the energy price cap, but we've got all the impact on businesses across the broader economy where there is no price cap. So what you're looking at here is the UK base electricity market for winter 2022 and the price evolution over the last couple of years. Now, the orange line is effectively the long-term average price of UK power, which we're running around about, say, £60 a megawatt. And that would have been a megawatt hour, sorry. And that would have been on average for the last 15, 20 years. The grey line is the peak power price that occurred during the 2008 financial crisis, which was the last time we saw some really extreme energy prices on a persistent basis. And now you can see currently we're looking at prices which are a good 4 or 5 times higher than that. These prices really impact businesses in the broader economy and uniformly. So for us, managing our way through this energy crisis and helping our customers do it provides a number of risks and opportunities for the business. So some of the ways that the energy crisis manifests itself practically, energy suppliers ultimately are starting to struggle to provide price proposals to customers. Those price proposals can be received in 1 hour and withdrawn in the next hour, and that creates a lot of reworking for the people in our organisation. Customers who wanted to speak about the energy market once a month historically now want to speak about it every other day. again, more work and activity required to service those customers. I think kind of ultimately, the energy crisis has the potential to really change the way the assurance market operates in the short to medium term. We haven't had any of those changes manifest themselves yet, but ultimately we should all be cognizant that just the range of outcomes is bigger now. What gives us comfort is that any of the kind of potential risks we see, we believe are offset by the potential upsides in optimization services. I think when you combine that then with labour cost pressures, with insurance costs, contractor costs, equipment costs, all of those things coming through, they all start to put challenges in relation to just the kind of way that the business operates and the kind of the way the business has to manage multiple factors on an ongoing basis. As I say, from our perspective, their challenges are out there we have to be cognizant of. We haven't seen them manifest to reality particularly yet, but as you look forward, investors should be aware, and we should be thinking about it in terms of there's an increased range of outcomes, but there's also an increased range of opportunities. So we think about that in relation to the operational review per segment. Paul will walk us through the financials of energy optimization, and then I'll walk you through some of the actual upsides and downsides in relation to that.
Thank you, Mark. So, as we say, a record period for the optimization services division, contributing a 49% increase in revenue, with the growth underpinned by the existing market conditions. The revenue performance of the period really driving that shift in revenue mix within the group. So optimization, the first half being the largest revenue contributors, 49% of group revenues in the period. EBITDA margin notably up on H121, and I guess more importantly, broadly in line with full year 21. With full year 21 at 17%, half year 16% as a result of product mix, where the period we yet to experience any cost inflation, and particularly in this division, any employment or contractor or equipment inflation that we've had to take the bottom line at this stage.
So what we like about the optimization service division at the moment is it's one of the key things that you can actually do to help businesses navigate their way through the energy crisis. So there's two types of conversations going on at the moment. There's the kind of conversation where somebody's got a supply contract expiring in October 2022, and that's really where the assurance service is kicking in, trying to support that client in what is a very, very difficult situation. However, many clients are actually hedged through to, say, October 2023, and that becomes a very different conversation, because there you've got clients where they might be, say, paying 11p a kilowatt at the moment, and we can tell now that in October 23 they're going to be paying 50 or 60p a kilowatt. And so from that perspective, what we're able to do with those clients is say, hey, look, guys, you've got this problem coming. We can do all these things about it. And all the things we can do about it generally relate to optimization services. So the particularly hot themes at the moment, making sure you've got your LEDs done, making sure you've got the building controls in, making sure you do things that will substitute electricity, like your on-site generation. So therefore, sticking solar PV into the premises and all of those elements. That's kind of where the key attention is. And what we've seen is paybacks on these projects tumble. So from that perspective, we really kind of are able to add value to clients to help meet that challenge of the energy crisis through these optimization services. That's manifesting itself at the moment in terms of record levels of pipeline. The growth in that division has been great anyway, but the actual potential for that growth to accelerate further is really looking very interesting into the next 12 months. I think kind of what's also important is for everyone to recognize how we do this. So a number of investors have said to me, okay, so are you winning lots of new business, going and actually talking to customers about all these opportunities to manage their way through the energy crisis? And the answer is absolutely not, because actually our optimization services are all about providing those services to our existing customers. And the thesis is a lot more powerful that way. So imagine you're trying to meet an organization to sell them some kind of optimization service, first of all, you've got to get through the door to the gatekeeper, past the gatekeeper. You've got to then talk about concept and sell the idea that your concept is good. You've then got to be given some data to prove that concept and to make it work. And then you've got to go all the way up through the decision-making chain to actually convince somebody to deploy the capital. Our process is very different to that. We're already working with these 3,500 customers on their actual energy cost equation. We're already helping with their budgets. We're already helping with their energy accounting. So we're already in the room. We're going to them not with an intellectual concept, but something that's already an opportunity that meets their capital investment criteria based on data, their data that we've already actually analysed. And from that perspective, it becomes a much neater conversation that can occur much more quickly, which is a really important part of managing the energy crisis in the current environment, because these projects need to be deployed as soon as possible to help the customers manage that challenge. So I guess ultimately the way we see at the moment is that energy optimization delivered great growth in half one, and from an outlook point of view, ultimately is one of the key things, in our opinion, that's really going to help businesses navigate their way through the energy crisis. So Paul, I'll talk you through the assurance division.
Yeah, thanks, Mark. So the assurance division performed in line with expectations in the period, still remaining the most significant EBITDA and cash contributors to the group. Margin slightly reduced in the period, which in part represents that increased support and resource required to support customers through the existing market conditions.
So if we think about assurance kind of and it's how it's impacted by the energy crisis, I think this is where you've got a broader range of outcomes. So what's the first thing that's likely to happen? There's likely to be more churn in this this marketplace, in terms of we've always been able to talk very consistently about our 85% client retention rate. What we've got now is we've got customers who are taking much shorter contracts. The number of times you've got to engage to renew those contracts is more frequent, and also they're going through very challenging circumstances. So it would be naive to think that we are not going to experience more customer churn in those conditions. We also benefit from this, right? Because our competitors experience the same, and we would observe that actually our new business performance is actually we've done as much new business so far this year as we did for the whole of 2021, which we think is also a reflection on the fact that we're benefiting from some of our competitors' churn. But when people look at the stats kind of going forward, it would be naive to think that retention rates are not going to change in this marketplace during this energy crisis. And the other challenge for the or impact of the energy crisis on the optimization division is in relation to organic growth. So for a number of businesses, when you're looking at going from paying 11p a kilowatt to 60 or 70p a kilowatt, the bottom line is some viable businesses are going to become unviable in that situation. Now, hopefully government intervention comes in and that becomes not so much of a problem, but we kind of need to all be cognizant of that risk and reward and that dynamic there. So from our side, I guess where we get to is that in the assurance division, you've got a broader range of outcomes. If we're executing on the right side, actually we'll experience kind of low retention rates, but we'll also experience higher new business rates. So from that perspective, our net retention could give us an opportunity, could give us a contraction. The risk of business failure impacting or demand destruction, impacting organic growth rates is there in the assurance division. But overall, what gives us underlying confidence is that we believe that if we're experiencing to the lower end of the kind of range of outcomes there, as in more of the risk of crystallizing, we would expect that to be more than offset by the performance of the energy of the optimization services division. We'll now focus on ESG and software.
Thank you, Mark. So ESG solutions, as you know, are newest division, very much performing at the higher end of management expectations, with a continuation and acceleration of revenue delivery 6 months on 6 months, delivering 1.2 million of revenue in the period and relatively modest contribution to EBITDA. The fact that business is performing at the top end of expectations means that we've slightly tweaked expectations for ESG in 22, with the division still expected to generate a loss, with that continuation in investment into ESG in the second half of the year to stimulate and accelerate that growth further into 2023.
Now, with respect to ESG, if you look at what's happening there, we're now at a stage where we've created a division and resourced it. We've now delivered solutions into our clients, and we're increasingly confident that we have the market-leading solution at the market-leading price point. Now, some people have said, well, won't the demand for ESG services dry up because there's an energy crisis and people are focused on cost, and is it really relevant anymore? Are all the various factors out there actually going to remove its relevance? What we're currently seeing is that ESG has become very clearly a revenue driving item. If you want to win a government contract, you must have certain ESG disclosures, you must have a net zero carbon plan, you must have a social value proposition. Those are non-discretionary. So anybody who wants to deal with the government has to be able to do that. We're seeing with kind of the larger customers who've got the kind of active investors that they are effectively very clearly seeing ESG as something they've got to do, and they're pushing that down their supply chain. So ultimately, at times of crisis, there's with the Energy Assurance division and the Optimization division us helping out our customers manage those costs, and then ESG is helping those businesses actually increase their revenues. And as such, the kind of cost of their services becomes kind of priceless in a way, because actually they're a prerequisite to making sure you don't lose your existing customers, or kind of actually in terms of our clients being able to actually generate and increase their revenue lines by winning new business. So we're seeing still some very strong dynamics there. I think kind of what's also interesting is that just the feedback we're getting on the products is really leading to a lot of referrals. And what's really interesting about ESG services is people don't know they've had a bad one until they've experienced it. And so whilst we're kind of pursuing our share of the land grab at the moment, actually the most interesting phase of this market for me comes next year, when actually people who've experienced an ESG service, we would expect to have paid more for it than we actually charge, because our data-driven approach is very cost effective. And actually the quality of our output we believe is higher. And the nice thing about that is that everybody's output is public domain. So from that perspective, it's quite easy to say to kind of customers, hey, look, you paid this and received that, you could pay that and receive this. And that becomes a really interesting dynamic as to how that kind of business unit's going to grow. So I guess overall, pleased with how it's performed so far and really excited by the outlook of it. Do you want to talk about software, Paul?
Yeah, so software revenues growing modestly in the period, 5% growth, EBITDA broadly flat. Adjusted EBITDA margin down period on period, however, in line with full year 21 margins of 74%, following that further investment into software solutions last year. So pleased with how the business is performing. I think one of the things we've seen in that division in the period is new business generation slightly down on expectations, which is why we're at the kind of lower end of management expectations on revenue growth. And that's because, particularly on the TPI customer side of that business, we're seeing people very mindful of deployment of cash and cost currently in the existing environment.
And so I think with software, I mean, what everyone needs to remember with that is that ultimately it's kind of a free hit. So we would have to spend our CapEx on software development to underpin our technology-enabled service. Regardless, we have to build these things. So from that perspective, by being able to actually generate a business which gives us a SaaS revenue from it as well, is just an upside. It would be silly not to take. So from that perspective, whilst kind of the current energy crisis probably stops some of the kind of TPI clients spending money on additional software, as we get to that crisis, we believe that we're well placed to actually increase the rates of growth in that division. At the moment, it's great. It washes its face and gives us that kind of additional revenue for CapEx we'd have to make anyway. But ultimately, we remain excited about some of the actual solutions we're delivering. And post the energy crisis, we expect that to turn into increased growth in that division. So how do we summarize this, guys? I think kind of ultimately, you've got the energy crisis, you've got some of the macro factors in relation to inflation, and they in particular create challenges for the energy assurance division. It should be really clear to everyone that that's range of outcomes. So we could still have kind of like actually a really good outturn there, but it would be remiss of us not to talk about the kind of fact there is a very real crisis out there, and there are some very real potential ways that crisis can manifest itself. However, what we see is that offsetting that is ultimately very strong drivers within the actual energy optimization services and the ESG services, which means that from an overall group point of view, we might be looking at a change in mix, but ultimately remain confident in relation to the board's FY22 expectations. Now placing that into kind of actually a kind of bigger overall outlook, going forward into kind of like 23 and beyond. One of the things that I guess we'd say is that if we looked at the business from an organic growth point of view, and we were driving a 5-year kind of plan in relation to that, we actually are probably more confident in that organic growth on a 5-year basis than we've ever been. And all of the kind of various drivers and even the kind of risk of the energy crisis are really testament to the strategy we put in 2018, where we implemented the optimization services division, and 2020 when we diversified into ESG. Both of those things have proven to be, I suppose, sensible things to do. What it does say to us, though, that is over the kind of next 6 to 18 months, the energy crisis has the potential to create some challenges. So in terms of recognizing that, what are we going to be doing right now? Well, ultimately, really focus on executing the current thesis, making sure we're adapting to the energy crisis as it evolves, making sure we focus on client needs and helping them through these challenges, managing the cost inflation that is undoubtedly going to affect many businesses. That means that we're also going to be pausing acquisitions. So I think investors were looking for a fairly clean year anyway, so we didn't have a lot that we were looking to do this year. But ultimately, at the moment, our bandwidth is focused on managing the short-term risks that come from the energy crisis and making sure we deliver on that medium to long-term organic growth thesis, in particular, maximising the opportunities afforded by optimization services. Thank you, everyone. Any questions?
Mark, Paul, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just using the Q&A tab situated on the top right-hand corner of your screen. Just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we've received a number of questions throughout today's presentation, and thank you to all the investors for submitting those. If I may, I'll read the first question, which reads as follows. Are the subsidiaries you recently acquired now fully integrated into the business, and are there any further acquisitions on the radar?
Yeah, so I think kind of in terms of integration, we always take a very pragmatic approach to that, and it's very much about meeting the needs of the individual business and the actual thesis on which we've kind of made the acquisition. So currently we would run the Businesswise acquisition as a kind of standalone business. We operate as a challenger brand, and that really gives us a neat way of managing against kind of people trying to say, it's biggest in the market, they won't care about the smaller customer, that sort of thing. Actually, we kind of have a brand of the business that is there to deal with people who would like to have a more boutique space service. So that runs on a standalone basis. Also the Ignite business, which really drives optimization services into a lot of the larger strategic clients where we roll out solutions across hundreds of stores and buildings for a particular client. We also run that on a, if you like, a standalone basis. It just creates a neater way of actually delivering on those optimization projects for those particular types of client, which really points to the top 200 clients in our organization. Every other acquisition that we've done is effectively now fully integrated into the Inspired business line, and we may have a couple of the brands that are still in the process of being retiring, but the rest of the brands will kind of transition to operating under Inspired.
Thank you very much. That's great. Just turning to the next question from Mazin, who asks, what is CapEx of around £6 million per annum spent on, and will these levels continue?
Do you want to break it down, Paul, in terms of the spend, and then I'll talk about the future side of it?
Yeah, absolutely. So currently we're spending internally circa 4.5 to 5 million on intangible CapEx development, which Mark can kind of take you through some of the areas where that cash is being deployed. And then you've got kind of other fixed asset expenditure making up the balance, which will be broadly flat over the kind of following 6 months. I think there's an ongoing live discussion around the property portfolio and what best fits the need of the business going forward, and in turn that might require further spend in terms of PPE. But for the time being, that should remain relatively flat.
So I think in terms of the kind of like the big bulk of the intangible spend, it very much is pointed at the kind of CapEx on software development. So the way we do that at the moment is ultimately we kind of run a Kanban process where the business is sized to be able to manage a certain number of parallel software development. So we think about those as dimensions of change, because a business can only manage a certain number of dimensions of change at a certain point in time. And ultimately that machine is sized to do 6, which means we're delivering at a point in time 6 different substantive solutions. And the cost of that effectively ultimately plays into that CapEx, and we're building new solutions which are there to kind of actually, I suppose, really speak to the point that energy is typically being a laggard in terms of technology, and therefore in some ways we're self-disrupting to make sure that actually we remain at the forefront and remain relevant for all of our customers, and also that translates into being able to kind of bring on new customers. So we've got a choice with that particular spend as to whether we keep doing it or whether we kind of pull it back, because it's really about our belief in the benefits of the next marginal project. So I guess kind of overall at the moment, that CapEx is expected to continue, but it's a lever we can pull should we need to kind of make other adjustments to the business as kind of actually kind of the realities of the energy crisis come through, and equally if the competitive landscape in the market changes.
Perfect. Thank you very much. Just moving on. Is there any recurring element to energy optimization revenues?
So the way to think about this is that every optimization project in its own right for a particular building is a project. So it's project-based revenues. And by definition, therefore, if you looked at that in isolation, you could think of it as one-off, apart from the fact that, let's say, you're putting in a piece of technology on a 5-year life cycle. You go 5 years forward, and there's a good chance that piece of technology has been superseded, and therefore it makes sense from a return on capital point of view to replace it. But I think kind of the question is that whilst they're project-based, what you've got is, so they're not recurring revenues, but you do have recurring demand. And what's important is how you specify or think about demand. So the way that we think about it is that demand within the optimization division is a client's propensity to deploy capital for the next best energy saving or carbon reduction project. And every company has got its own level and, if you like, range it will go to on that. So what you end up with is 1 year you do a set of projects for a customer, and then the next year, if they've still got a propensity to deploy capital for kind of actually reducing energy consumption or reducing carbon, then you've got a recurring demand for the next best project and the next best project. So it kind of goes in a wave and over a 5-year period. And then you'll get to that in a 5-year period and the replacement projects will start. So if you looked at one of our big customers that we've had via the Ignite division for the last kind of 8-9 years, it would be fair to say that they've spent more than £1 million a year with us on energy optimization projects kind of each year. Sometimes it's been 2, sometimes it's been 1.5, but there's been that recurring demand, that kind of propensity to deploy capital to get the next best opportunity. And so ultimately for us, when we're working with customers, we're forever working with them on identifying that and putting those opportunities in front of them. Their propensity to deploy the capital will then say which ones they do. But also that propensity to deploy capital changes over time as well. And what we're seeing at the moment, clearly with the energy crisis, it's very, very high. And pre the energy crisis, we were seeing it was high because of the drive to net zero. So overall, the tailwinds, the favourable environment for optimization projects for us just looks like it gets better and better.
Mark, thank you very much for that. The next question relates to share buybacks and asks, would you consider a share buyback program given the share price?
Yeah, so I think it raises an interesting question around capital deployment for the business over the next 12 to 18 months. We've touched on M&A, natural pause in terms of M&A for various reasons. But in terms of capital deployment, we're in a situation where we've got, per the balance sheet, you'll note there's current contingent consideration of just under 10 million, which we paid over the next 12 months. Now, that's not to be paid in the next 6 months, so not prior to the end of the current year end, but will be paid in the first half of next year, similar to the profile of contingent consideration paid in this year, based on 22 performance and those businesses performing well for the remainder of the current period. And that's just under £10 million. You've got a situation as well, which we've outlined in the optimization business, of a significant opportunity. So we've currently guided the market that optimization will generate 29% increase in organic growth in 23. The pipeline suggests there's an opportunity to materially outperform those numbers. And as we know, the optimization business has a capital requirement in terms of working capital to deliver that rate of growth. So currently we're guiding to an outflow of working capital next year of about 2.7 million to deliver that 29% increase in optimization revenue. Clearly, if optimization performs materially ahead of that expectation, then that will have a working capital requirement. So I think the answer to the question in the near term is no, because the situation where our tolerance for debt and our shareholder tolerance for debt has been quite clearly set at 2 times net debt to EBITDA. We're comfortable to be notably below that come this year end, with the peak net debt position being at the half year following those contingent consideration payments earlier this year. And then it's about ensuring that we can facilitate the opportunity within optimization in terms of working capital requirement, while also paying the contingent consideration over the next 12 to 18 months, because of the acquisitions back in 2020 and 21 are potentially going to perform at the higher end of management expectations.
Perfect. Thank you very much for that, Paul. The next question is around energy optimization and reads as follows. I'm new to the company, so apologies for the question, but when you mentioned that paybacks are much shorter due to the high energy prices, what assumption have you made about medium-term cost of energy?
Yeah, and so for a lot of the projects that are being deployed at the moment, they all fall within the current forward curve. So you've got a forward curve of the markets, which is going to take you forward 4 or 5 years. So ultimately, as long as the payback of the project was originally kind of in a 4 or 5 year period, you can actually hedge out the return, because you can effectively sell the energy forward that you're going to save from the project. So that kind of idea of it being based on some kind of assumption to which the client's at risk of, in other words, what happens if the prices fall, you suddenly don't get your return on capital, that's not an issue for anything that's within that kind of 5 year horizon. If you were doing something longer term, What we would tend to normally do is kind of look at the commodity markets and have them mean reverting on a 5-year basis to the actuals, and then actually add on your transmission distribution costs on top of that. I think one of the things that we're all now very focused on the commodity prices, because they're now the dominant part of the mix. But at kind of normal long-term energy price level, commodity price levels, they're only normally 30% of the cost stack, and you've got a what's expected to be a kind of continuous inflation in the cost of transmission and distribution as the networks kind of actually continue to build in resiliency for renewables and everything else. So I think you look at just the way the optimization projects work. The paybacks were good pre the energy crisis. They're just kind of it becomes very an organisation would find it very difficult to find something else that will give them a better return in terms of deployment of their capital at the moment than saving energy. And any of the longer term ones, like I say, would still wash their face. And I think kind of the bigger thing we saw as well was that actually companies from a net zero carbon point of view are willing to kind of operate on ultimately lower hurdle rates to kind of make if the project they're implementing will also help them on the journey to net zero.
Perfect. Thank you very much. Got another question here, which reads as follows: have you changed the basis of billing assurance services so it's more fixed in nature and less linked to consumption billing?
So it's an ongoing program. So I guess you've got basically the thing of where we move someone to away from recovery via the supplier of the fees into direct recovery from the customer. That naturally happens. We've got some customers who still want recovery via the supplier, and it's a program we work through them with, and that happens at the point of renewal. I think kind of we were seeing better traction with that pre the energy crisis. Certainly the energy crisis just meant everyone wants to try and normally keep their contracting structures as they were and focus on solving the problem of the energy crisis. So it's something we continue to work on. The percentage, I'm trying to think, Paul, the percentage of our revenues now that are linked to consumption?
Yeah, so within the assurance division, our assurance revenue line, 70% is still recovered by the supplier, 30% direct billing. So if you then gross that up in terms of group revenue, noting that because of the acceleration optimization, which is all direct billing and none of which is recovered by the supplier, at group level, group revenues are now kind of between 30-35% recovered by the supplier, 70 to 75% or 70% recovered via direct billing to the customer.
Perfect. Thank you very much. And the final question we have here is: can you not take a share in client savings from optimization projects to generate recurring revenues?
So I think the thing about those, this is always a misconception. I think that the kind of where you take the share, you could do a shared savings approach, and certainly we're open to doing that. I think when people try and actually talk about those as recurring revenues, I'm not sure that's necessarily true. I think kind of actually ultimately there's a point over the life of the project where that they normally stop. So it's a payment plan, but actually you can generate more revenues doing that. It all depends as to where the client's at in relation to what's best for them. So if we're at risk on the project and we're deploying the capital, then ultimately a share of saving may well be the best way to do it. If our client is deploying the capital, then ultimately our job is to do the best for the client. And I think kind of when we look at our long-term relationships, we're increasing now, we're helping the client with their assurance, their optimization, and their ESG. We prefer that model as being the right way to actually have that kind of enduring relationship with the client.
Mark, Paul, thank you very much for that. I think you've addressed those questions you can from investors, and of course the company will review all questions submitted today and publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to you both, Mark, could I just ask you for a few closing comments?
Yeah, so I mean, look, we're really pleased with the H1 interim results in the context of the challenges in the marketplace. I think the key takeaways are that the range of outcomes look wider than they've ever looked in relation to the assurance division. And I've been doing this for the last kind of like 22, 23 years. But those risks and opportunities may give us an upside, may give us a downside. But overall, I guess our underlying view at the moment is that those are compensated for by the favourable dynamics of the optimization division, which really is the key lever for helping all the businesses within the UK manage their way through this energy crisis, which we're focusing on doing.
Mark, Paul, thanks once again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few minutes to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Inspired PLC, we'd like to thank you for attending today's presentation, and good morning to you all.
Thank you.